This is the topic we are looking at. Transfer pricing regulation in Nigeria. We are going to start with introduction. Transfer Pricing Regulation Act was signed into law in 2012 in Nigeria, and it commenced in 2nd of August 2012. The whole essence of this Transfer Pricing Act, Regulation Act 2012, is to fight against the issue of tax avoidance. Is to fight against the issue of tax avoidance, most especially among multinational companies. Now, and secondly, transfer pricing regulation also has an objective of ensuring that when there is transfer of goods and services between interrelated parties, that transfer of goods and services should be done at arm's length. That transfer of goods and services should be carried out at arm's length. That is the whole essence of transfer pricing regulation. To proceed further, we need to define transfer pricing. To proceed further, we need to do what? Define transfer pricing. What do you understand by transfer pricing? Transfer pricing is the general terms that is used for pricing of goods and services between interrelated parties across the cross-border. Transfer pricing is the price at which goods and services is transferred between interrelated companies that are located in different countries. When you have a parent company in UK and the subsidiary is in Nigeria, if the parent company sends goods to the subsidiary, the price that the parent company is going to charge for sending the good to the subsidiary in Nigeria is called transfer pricing. And that price must be at arm's length price. That means that price must be a fair value price. That is the transfer pricing. We regulate transfer pricing in tax. FRS, they are the regulator of transfer pricing. Why does FRS regulate transfer pricing? Because in the past, so many multinational companies, they have been using transfer pricing as a means of engaging, as a method of carrying out base erosion profit shifting, as a method of shifting profit from one jurisdiction to another. They will sell goods to their subsidiary in an high tax jurisdiction country, and they will charge an arbitrary price so that the profit of their subsidiary will reduce and the tax will reduce. Companies have been using the transfer pricing to reduce the tax that they will pay. We now, in Nigeria, FRS now said, as from 2012, precisely 2nd of August 2012, we need to regulate the price of goods and services that is being carried out between interrelated parties. We are going to be the one, the tax authority is going to be the one to fix the price, not the seller. The tax authority, they are going to set some criteria of determining the price in which the goods and services is going to be transferred between interrelated parties. That is the whole essence of transfer pricing. Scope of transfer pricing regulation. That transfer pricing regulation that was signed into law in Nigeria in 2012. What is the scope? What does it cover? The scope of transfer pricing regulation include the following: sale and purchase of goods and services is one of the scope of transfer pricing regulation. Another scope of transfer pricing regulation is provision of services. Another one is lending or borrowing of money. Lending or borrowing of money. We have another one called license or use of intangible assets. Another scope of transfer pricing regulation is license or use of intangible assets. We also have another scope, it's called sales or lease of tangible assets. Like I said, another scope of transfer pricing regulation is sales or lease of tangible assets. Lending or borrowing of money too is part of scope of transfer pricing regulation. Is part of scope of transfer pricing regulation. Transfer pricing in Nigeria started in 2012, like I said. It was signed into law in 2nd of August 2012. And in October 2012, FRS set a guideline on transfer pricing regulation between interrelated party transactions. The word interrelated party, we mean subsidiary and parent company, associate company, joint venture. They are interrelated parties. So administration of transfer pricing regulation. Administration of transfer pricing regulation. Who administer transfer pricing regulation? Transfer pricing regulation is administered by who? By FRS, Federal Inland Revenue Service. And at the end of every year, multinational company, a company that have a subsidiary or parent company in abroad, must file a return called annual transfer pricing return. Also, local companies too that have a subsidiary in Nigeria and the parent is also in Nigeria, like Dangote group of companies too, they are expected to file what? Transfer pricing regulation. At least not later than 6 months after the end of the year or 18 months from the date of commencement of business. So that is annual transfer pricing return. This filing of annual transfer pricing return can be extended. Annual transfer pricing return can be extended if the company seek the approval of FRS for extension. If the company seek the approval of FRS for extension. And still more on this administration of transfer pricing regulation. We said transfer pricing is regulated by FRS. In the office of FRS, there is a department called Transfer Pricing Department. It is this department that is responsible for regulation and review of transfer pricing transaction. It is this department that is responsible for regulation and review of transfer pricing transactions. Now, what is the objective of transfer pricing regulation? Objective of transfer pricing regulation. What are the objectives of transfer pricing regulation? Number one objective of transfer pricing regulation is to ensure that Nigeria is able to tax on appropriate taxable basis corresponding to the economic activities deployed by taxable persons in Nigeria. Number one objective of transfer pricing regulation is to ensure that Nigeria is able to tax on appropriate taxable basis corresponding to the economic activities deployed by taxable persons in Nigeria. Another objective of transfer pricing regulation is to provide...
Sir, please, can you throw more light? Sorry, sir, please.
I can't hear you.
Hey, please, can you throw more light on the first objective?
Okay. We are saying that to ensure that Nigeria Tax Authority, the tax appropriate any transaction that arise between interrelated parties, that they tax them in a fair and reasonable manners. There is no bias in taxing transactions that arise between interrelated parties. Is to ensure that when tax authority is taxing them, they are taxing them in a fair and reasonable manners. That is what that number one is saying. Number two objective of transfer pricing regulation in Nigeria is to provide the Nigeria Tax Authority to provide what? The Nigeria Tax Authority the tools to fight tax evasion, to provide Nigeria Tax Authority the tools to fight tax evasion through over or underpricing of control transaction. Through over or underpricing of what? control transaction through over or underpricing of control transaction between associated enterprise. Between associated enterprise. Another objective of transfer pricing regulation in Nigeria is to reduce the risk of economic double taxation. To reduce the risk of economic double taxation. Like I said, one of those objectives of double taxation transfer pricing regulation is to reduce the risk of economic double taxation. Under our double taxation relief, we have talked about economic double taxation. Economic double taxation simply means a situation whereby the same income is taxed twice in the hand of the same taxpayer. A situation whereby same income is taxed twice in the hand of who? In the hand of the same taxpayer. Another objective of transfer pricing regulation is to provide a level playing field. Between multinational enterprise and independent enterprise doing business within Nigeria. To provide a level playing field between multinational enterprise and independent enterprise doing business within Nigeria. Why the last objective of transfer pricing regulation is to provide a taxable person with certainty of transfer pricing treatment in Nigeria. To provide a taxable persons with certainty of transfer pricing treatment in Nigeria. These are the objectives of transfer pricing regulation. These are the objectives of transfer pricing regulation. The other area we need to look at is called transfer pricing policy. Transfer pricing policy. What is transfer pricing policy? Transfer pricing policy is a document that is required to be filled by the company with the transfer pricing unit in FRS. This document, every company, multinational company that has subsidiary in Nigeria, group of company, they will fill it with who? With FRS in Nigeria. Transfer pricing policy, like I said, is a document containing the guideline or that guide the conduct of related party transaction within a group of companies. A document that guide the conduct of related party transactions within a group of a company is called transfer pricing policy. A document that guide the conduct of related party transaction within a group of companies is called transfer pricing policy. This transfer pricing policy, every company must fill the transfer pricing policy at the beginning of every year, and they will submit it to transfer pricing units within the FRS. Transfer pricing unit of the FRS. They will have the transfer pricing policy of every company. Type of transfer pricing policy. We have group transfer pricing policy. There are two types of transfer pricing policy. Group transfer pricing policy and local transfer pricing policy. Group transfer pricing policy is a transfer pricing policy designed by a group of companies. A group of companies that is outside Nigeria and they have a subsidiary in Nigeria that is outside Nigeria and they have a what? They have subsidiary in Nigeria. It's a group transfer pricing policy. Local transfer pricing policy is a transfer pricing policy designed by a local company within Nigeria. Those local companies, they have a subsidiary in Nigeria or they have a related company in Nigeria. That is local transfer pricing policy. Features of transfer pricing policy. What are the features of transfer pricing policy? What are the features of transfer pricing policy? Number one, they are typically prospective in nature. They are typically prospective in nature means they normally change from time to time. They are prospective in nature. They change from time to time. And they contain the details, the detailed background of the companies. So number one features of transfer pricing policy is they are typically prospective in nature. Number two features of transfer pricing policy is they are typically not updated unless there are significant changes in business. They are typically not updated unless there is significant changes in business. Another features of transfer pricing policy is they provide feature view of likely intercompany transaction. They provide feature view of likely intercompany transaction. Why the last features of transfer pricing policy is they provide guidance on pricing of transaction and methodology. They provide guidance on pricing of transaction and methodology. They provide guidance on pricing of transaction and methodology. These are the features of transfer pricing policy. These are the features of transfer pricing policy. Now, transfer pricing disclosure. The next heading we are looking at is called transfer pricing disclosure and declaration form. Transfer pricing disclosure and what? Declaration form. What are the content of transfer pricing disclosure and declaration form? This transfer pricing disclosure and declaration form must also be submitted by company to FRS. They must submit it, but every multinational company, they must submit the transfer pricing disclosure and declaration form at the beginning of every year to the FRS. What are the content of this transfer pricing disclosure and declaration form? Content of transfer pricing disclosure and declaration form. Number one content of transfer pricing disclosure and declaration form is particulars of reporting company. Particulars of what? Reporting company or entity. Particulars of reporting company or entities. Particulars of reporting company or entities is one of the content of transfer pricing disclosure and declaration. Content of transfer pricing disclosure and declaration form. Particulars of reporting companies. Particulars of what? Reporting companies. Another one is particulars of immediate parent companies. Particulars of immediate parent companies. Particulars of directors of reporting companies. Particulars of directors of reporting companies. Why another content is particulars of 5 major shareholders of reporting companies. Particulars of 5 major shareholders of reporting companies. Another content of transfer pricing declaration or disclosure form is particulars of external auditors. Particulars of external auditors. Particulars of subsidiary and other connected persons. Particulars of subsidiaries and other connected persons. We also have particulars of company secretaries and reporting entities. Particulars of company secretaries and reporting entities. While the last content of transfer pricing disclosure and declaration form is particulars of the persons making the declaration, particulars of the persons making the declaration, that is content of transfer pricing disclosures and declaration form. Now, let's talk about transfer pricing return, filing of transfer pricing return. Filing of transfer pricing return. Like I said, at the end of every year, 6 months after the end of accounting year, a company must file a return, and that return is called transfer pricing return. At the end of every year, a company must file a return, and that return is called transfer pricing return. Of transfer pricing return, annual return must be filed at the end of the year. Every company must file transfer pricing return to FRS at the end of every year. A company that will deal with transfer pricing, I'm talking of group of companies, 6 months after the end of the year, they must file transfer pricing return. And that transfer pricing return that they must file has the following content. What are the content of transfer pricing return? Number one, transfer pricing documentation. Transfer pricing what? Documentation. Number two, transfer pricing policy. Transfer pricing policy. That is number two content of transfer pricing return. Why number three content of transfer pricing return means completed and signed transfer pricing disclosure and declaration form. Completed and signed transfer pricing disclosure and declaration form. We have another one called, another content, audited financial statements. Another content of annual transfer pricing return. Audited financial statements. Company income tax self-assessment. Company income tax self-assessment is also content of transfer pricing return. Why the last one is called tax computation, including all relevant schedule. Tax computation, including all relevant schedule. These are the content of transfer pricing return. These are the content of transfer pricing return. Now, the next heading we need to look at is called connected persons, connected taxable persons in relation to transfer pricing. Who are the connected taxable persons in relation to transfer pricing? Like we know, connected person means two or more party or company that are connected together as a result of what? Ownership structure. Two or more companies that are connected together as a result of ownership structure or business relationship. These are connected persons. These are connected persons. What are the examples of connected persons under transfer pricing? What are the examples of connected person order transfer pricing? An entity, which means a parent company is connected to its subsidiary, or a company is connected to the joint venture or associate. So entity dealing with any entity dealing with related parties such as subsidiary, associate, joint venture, they are connected persons. Another examples of connected persons is member of a local group of companies. Member of a local group of companies, they are also what? A connected persons. Members of a local group of companies is also a connected persons. Any entity with pioneer status is a connected persons. Pioneer company among themselves, they are connected persons. Any entity in a group located in free trade zone, any entity in a group located in free trade zone is also what? Connected persons. Related parties subject to different tax rates is also a connected persons. Why an entity with permanent establishment is also a connected persons. So these are examples of connected persons transactions. These are examples of connected persons transactions. The next heading we need to look at is called arm's length comparability factors in transfer pricing. Arm's length comparability factors in transfer pricing. What are the factors that FRS will use to determine whether a transactions between interrelated party is carried out as arm's length or not? Arm's length comparability factor in transfer pricing means those factors that FRS will use to assess whether a transaction is done as arm's length or not. What are the factors? Number one of the factors is similarity or identical nature of the transaction. Similarity or identical nature of the transaction is one of the factors that they use to determine whether a transaction is carried out at arm's length or not. Another one is the facts and circumstances of the transaction per economic relevance. The facts and circumstances of the transaction per economic relevance. The facts and circumstances of the transaction per economic relevance. We also have another one. The characteristics of the goods and services transfer. The characteristics of the goods and services transfer is another factors that is used to determine whether a transaction is at arm's length or not. Another factors is the function undertaken by persons entering into the transactions. The function undertaken by persons entering into the transactions. The function undertaken by persons entering into the what? Into the transactions is another factors of arm's length. The contractual terms of the transactions too. The contractual terms of the transaction will help us to determine whether this transaction is carried out as arm's length or not. The contractual terms of the transactions will also help us to determine whether the transaction is done at arm's length or not. Why? Another one is the economic circumstances in which the transaction is taking place. The economic circumstances in which the transaction is taking place. The economic circumstances in which the transaction is taking place will also help us to determine whether a transaction is carried out at arm's length or not. The economic circumstances in which the transaction is taking place. The economic circumstances in which the transaction is taking place will also help us to determine whether a transaction is carried out as arm's length or not. Now, the next area we should look at is fines and penalties. Fines and penalties relating to transfer pricing regulation in Nigeria. Fines and penalties relating to transfer pricing regulation in Nigeria. What are the fines and penalties relating to transfer pricing regulation in Nigeria? Number one, fines and penalties relating to transfer pricing regulation in Nigeria is failure to disclose control transactions. Failure to disclose control transactions. Failure to disclose control transaction shall attract a penalty of 10 million naira or 1% of the value of the transaction. Plus 10,000 naira every day in which the failure continue. Plus 10,000 naira every day in which the failure continue. Number one offenses relating to transfer pricing regulation in Nigeria is failure to disclose control transaction. If you fail to disclose control transaction, that company will pay a penalty of 10% or they will pay penalties of 10 million naira or 1% of the value of the transaction, whichever is earlier, whichever is higher, plus 10,000 naira for every day in which the failure continued. Another penalties relating to transfer pricing in Nigeria is late filing of country by country return. Late filing of country by country return. If you fail to file country by country return, what is the penalties? Late filing of country by country return. The penalties is 10 million naira in the first instance and 1 million naira every month in which the failure continue. failure to file country by country return. The penalties is 10 million naira in the first instance and 1 million naira every month in which the failure continue. 1 million naira every month in which the failure continue. These are the offenses relating to transfer pricing in Nigeria. The next thing we need to look at is called method of transfer pricing. What are the methods of transfer pricing? What method do we use to transfer and services between interrelated parties? What method do we use to transfer? What pricing method? Method of transfer pricing. What pricing method do we use to transfer goods and services between interrelated parties? Number one method of transfer pricing is called comparable uncontrolled price method. Comparable uncontrolled price method. Comparable uncontrolled price method. This method charge price for transaction between associated companies with they now compare the price that was charged for transaction between unrelated companies. Example of comparable uncontrolled price method. If A and B, they are associated companies, they are related. Maybe A is the parent, B is the subsidiary. If A sells good to B, what price A is going to charge? We are going to look at if the transaction is going to take place by two parties that are not related. Take for instance, C and D, they are not related. They now say C now sell good to D. The same good A sell to B, C sell it to D. What is the price C charge D while selling the good to D? That price C charge D is what we are going to use for the transaction that takes place between related parties. Comparable uncontrolled price method means the price imposed. That means the price charged between related parties should be the same price that will be charged between unrelated parties in a particular in a similar transactions. In what? In a similar transaction. Those transactions that are distinct. Like I said, A and B are related. One of them is subsidiary, another one is parent. A now sells good to B. The question is, the price A should charge B must be the price that will be charged if the same transaction want to take place between unrelated parties. C and D are unrelated parties. If C want to sell similar good to D, how much is he charging? That price is charging is the comparable uncontrolled price that A and B must use to determine the transfer price. That is comparable uncontrolled price. Another method of transfer pricing is called resale price method. Another method of transfer pricing is called what? Resale price method. Resale price method means the price that is charged if the good and services want to be disposed to an independent enterprise. In resale price method, we mean that we are looking at the price that will be charged if A want to sell that good to C. C is an independent enterprise. It does not relate to A. But A and B are related because of subsidiary and parent. What will be the price that A will charge if they want to sell that similar good to C? That is resale price method. Resale price method begin with resale price to an independent enterprise of a product purchased from an associate enterprise. If external party want to come and buy the good, how much are you going to sell it to him? The price you are going to sell it to him is that resale price method. That is the resale price method. Another method of transfer pricing is called cost plus method. Cost plus method. Cost plus method. This cost plus method means if one party in a related party want to sell good to another party, if one of the related party want to sell good to another, they should charge a cost plus method, meaning the cost of that good plus a particular percentage, which is a markup price. That particular percentage is the profit element of the transaction. How much do you buy the good? How much are you adding? Are you adding 20% markup or 25%? That is cost plus method. Cost of the good plus markup profit plus markup profit. That is the price that will be charged by associated company in a related party transaction. That will be the price that will be charged by associated company in a related what? Party transactions. That is cost plus method. Another method that we have, apart from cost plus method, we also have another one called profit split method. Profit split method. In profit split method, we need to determine the combined profit from the transaction. That combined profit from the transaction, we are now going to split it into two. The seller is going to take one, while the buyer is going to take one. In a profit split method, we need to determine the combined profit that arise from a business transaction. Yes. We need to determine the combined profit arising from a business transaction. From the combined profits, the two independent parties to the transaction will now split the profit into two. We are going to use that to determine the transfer pricing. So, ladies and gentlemen, this is all what we need to understand on transfer pricing. This and on transfer pricing. So, in this my material, I have examinable questions on transfer pricing. I have examinable question on transfer pricing. One of the examinable questions I have is talking of country by country reporting. Country by country reporting means group of companies every year, at the end of every year, a group of companies must prepare a report called company by company report. And it must submit it to the tax authority of the head office of the parent company that have subsidiary in different countries. That is the head office. They must prepare a report called company by company report. In that company by company report, when we submit the report to the tax authority in their jurisdiction, that report will show the turnover of the parent and turnover of all the subsidiary under the parent. It will also show the cost of sales of the parent. It will also show the cost of sales of all the subsidiary of the under the parent in a tabular form. At the end of the day, if there is any interrelated party transaction between them, that interrelated party transaction must be shown in the country by country reporting. That interrelated party transaction must be shown in the country by country what? Reporting. So that is the whole essence of country by country reporting. That is the whole essence of country by country reporting.
All this.
So, examinable question 1. Please, let's try to attempt that examinable question 1. Let's try to attempt it. Examinable question 1. Examinable questions 2 is talking about the scope of transfer pricing regulation. What are the scope of transfer pricing regulation? Examinable question 2 is talking about that too. We can look at that too and attempt them. We should attempt examinable question 2 too. So we also have examinable to question 3 is the one that talk about scope of transfer pricing regulation. The scope of transfer pricing regulation, examinable question 2 talk about that. What are the scope of transfer pricing regulation? He said items that constitute control transaction. What are the items that constitute control transaction? Sales and purchase of goods and services, sales, purchase and lease of tangible assets, purchase and licensing of tangible assets, provision of services, lending and borrowing of money, manufacturing arrangement. All these are items that constitute control transaction. And it is also asked, discuss arm's length price. What is arm's length price? Is the price charged for the transfer of goods and services between connected persons, connected taxable persons, which corresponded to the price that will be charged by who? By independent party. Arm's length price means the price that will be charged between connected parties, which is going to be the same that is going to be charged by independent party. If A and B is connected, if A and B sell goods to one another, the price A and B must charge must be an arm's length price. That means it must be the price that will that C and D charge when they sell goods to one another. C and D are not connected. They are independent parties. So arm's length price means the price that will be charged for transfer of goods and services between connected persons, which is going to correspond to the price that will be charged between what? Independent persons. So that is that. So number 2, let's try to look at that number 2 question very well. It's an interesting question. And another area we should look at, we can look at on this transfer pricing, is called advanced pricing arrangement. Advanced pricing agreement, sorry. Advanced pricing agreement. What is advanced pricing agreement? APA. Advanced pricing agreement allow for avoidance solution of complex transfer pricing issue. When there is a transfer pricing issue, conflict between the taxpayer and the tax authority, how do we resolve it? We are going to resolve it through an agreement called advanced pricing agreement. This advanced pricing agreement is basically saying that we should apply transaction between related parties. We should consider the use of arm's length principle while applying transaction, while looking at transaction between related parties. We should consider the principles of arm's length. We should apply arm's length principles. And under this advanced pricing agreement, we have some content under the advanced pricing agreement. One of the content under the advanced pricing agreement is description of the activities of taxable persons to be addressed. When there is conflict, the way of resolving conflict in transfer pricing is through advanced pricing agreement. So one of the content of advanced pricing agreements is description of the activities of taxable person to be addressed. Why another content of advanced pricing agreement is a detailed description of the control transaction to be included into the scope of advanced pricing agreement. Why another one is a proposed duration of advanced pricing agreement, a proposed duration of advanced pricing agreement. Another content of advanced pricing agreement is critical assumption to the future event under which determination is proposed. These are the content of advanced pricing agreement. These are the content of advanced pricing agreement. We also look objective of country by country reporting. What is the objective? Why multinational company, which is the parent company, will do a country by country reporting? What are the objectives of company by country reporting? Like I said, number one objective of country by country reporting is to provide tax authority with information about what? About multinational enterprise global activities. To provide information about multinational enterprise global activities. Another one is to provide tax authority with information that will be used to assess international tax avoidance risk. To provide tax authority with information that will be used to assess international tax avoidance risk. Why another one is to improve transparency, of multinational enterprise in their tax practice. Another objective of country by country reporting is to improve transparency of multinational enterprise in their tax practice. Another objective is to prevent tax evasion and avoidance through base erosion profit shifting. To prevent tax evasion and avoidance through base erosion profit shifting. So these are the objectives of country by country reporting. So these are the major areas we need to look under this transfer pricing regulation. So in transfer pricing regulation, let me just summarize what we have discussed so far. We talk about what is transfer pricing. We look about the scope of transfer pricing, and we also talk about objective of transfer pricing. After looking at the objective, we now look at transfer pricing policies. We look at features of transfer pricing policy. After that, we now look at transfer pricing disclosure and declaration form. We look at the content. After the content, we now look at annual transfer pricing return, filing of annual transfer pricing return. What are the contents? We look at that too. We also look at connected taxable persons. We give example of connected taxable persons. From there, we go to arm's length principle. We look at the factors that will be considered to determine arm's length principle. So these are the major areas that we look at in this topic. So any question, any issue?